Welcome to Lukebook Money, built for Singapore. Today, why DBS, UOB, and OCBC just went on the greatest run in their history. And whether it can last. Here's the real story. Quick favor before we start. If you're new to Tiger Brokers, just tap the link in my description below, or key in the code on your screen when you sign up. We both earn $90, and it quietly keeps these daily videos free. Thank you. Now, let's get into it. As the market closed today, Singapore's three big banks did something they have done over and over for years now. Together, they touched a fresh all-time high. Another record, in a long run of records. If you own an STI ETF, or a CPF-linked fund, or almost any Singapore share portfolio, you own a piece of them. These three banks are woven into nearly every Singaporean's wealth. DBS, OCBC, and UOB. Three names most of us have banked with since we were children. And over the last few years, they have quietly become some of the best-performing large stocks in Asia. A few years ago, these banks traded near their book value. The market barely gave them credit for the assets they held. Today they trade far higher, and they keep setting new highs. In 2024, the three of them together earned around $25 billion in profit. Record numbers, all three, in the very same year. So the natural question, and the honest one, is simply this. Why? Why have these banks won so consistently? And the harder question, can it last? In the next 40 minutes we'll walk through 5 forces that lifted these banks, look honestly at whether the run can continue, and ask what it all means for your own money. This is not a hype video. I'm not here to tell you to rush out and buy anything. And a quick, honest note before we start: this is education, not financial advice. There's an old saying that even the tallest tree grew from a quiet seed. The story of how these banks got so tall is worth understanding slowly, from the roots up. Here's the thing most people miss. You may not think of yourself as a bank shareholder. But through CPF, through index funds, through your parents' portfolios, you very likely are. And when so much of a nation's savings sits inside just 3 companies, understanding them is not optional. It's part of understanding your own future. Together, these 3 banks make up close to half of the entire Straits Times Index. When they move, the whole market moves with them. So let's start at the beginning. What exactly are DBS, OCBC, and UOB? And how did 3 banks from a small island grow into giants? DBS was born in 1968 as the Development Bank of Singapore. It was set up to fund the young nation's industrial growth. Today it is the largest bank in Southeast Asia. OCBC, the Overseas Chinese Banking Corporation, was formed back in 1932, from the merger of 3 older banks during a hard decade. It is one of the oldest names in the region. UOB, United Overseas Bank, was founded in 1935 by a Sarawak businessman named Wee Keng Chang. It is still guided today by that same founding family. 3 banks, each with almost a century of history behind it. They didn't appear overnight. They were built slowly, through wars, through crises, and through Singapore's own rise. People call them the national champions. That's not just a nice phrase. They are systemically important, so central to the economy that the country simply cannot let them fail. They sit under the watch of the Monetary Authority of Singapore, one of the strictest regulators in the world. That tight supervision is a big part of why they're seen as so safe. Here's the scale of them in 2024. DBS earned around $11.4 billion. OCBC about $7.6 billion. UOB around $6 billion. Every one of them a record. Between them they serve tens of millions of customers across Asia, in Singapore, Malaysia, Indonesia, Greater China, India, and beyond. Their reach stretches far past our shores. But at heart, what does a bank actually do? Strip away the branches and the apps, and the business is beautifully simple. It's worth understanding, because it explains everything that follows. A bank takes in your deposits and pays you a little. It lends that money out to others at a higher rate. It keeps the gap in between. And it earns fees on services along the way. That gap between what they earn on loans and what they pay on deposits is the heartbeat of a bank. Remember it. Almost everything about the last few years comes back to that spread. And here's their quiet advantage. A huge share of their deposits sits in everyday current and savings accounts that pay almost nothing. Cheap money in, higher-yielding loans out. The big Singapore banks hold a very large, very sticky base of low-cost deposits. That stable, cheap funding is one of the most valuable things a bank can possibly own. They're not only lenders, though. They sell insurance, manage investments, handle trades, move money across borders, and look after the wealth of the rich. Many engines, not just one. And underneath it all sits one intangible thing: trust. People keep their life savings with these banks because they believe the money will be there tomorrow. That trust took decades to build. Now, back to that point about the index. Roughly half of the Straits Times Index is just these three banks. So the health of the whole market is tied to their health. So that's what they are: old, trusted, dominant, and simple at their core. The real question is what lit the fire under them. And that begins with interest rates. This is the big one. If you understand nothing else today, understand this force. The single largest reason these banks sought was a once-in-a-generation move in interest rates. Remember that spread earn more on loans than you pay on deposits. Bankers have a name for it. They call it the net interest margin. It's just the spread, expressed as a percentage. Think of net interest margin as the bank's gross profit on every dollar it lends. A wider margin means more profit on the same loan book. Small changes here move billions. For most of the 2010s, interest rates around the world were pinned near zero. Central banks had cut them to the floor to fight one crisis after another. And that was hard for banks. When rates are near zero, the spread gets thin. Banks can't charge much on loans, and there's no room to pay less on deposits. You can't pay below nothing. Margins were squeezed. In 2021, DBS's net interest margin was only around 1.45%. The banks were solid, but their core engine was running cool. Then the world changed. In 2022, inflation surged across the globe. Prices for almost everything jumped. And to fight it, the world's most powerful central bank stepped in hard. The United States Federal Reserve began raising interest rates at the fastest pace in decades. From near zero, up and up, meeting after meeting. One of the steepest climbs in modern history. By the middle of 2023, the American policy rate had reached a peak of around 5.25% to 5.5%, the highest in more than 2 decades. A stunning move in barely a year and a half. Now, why does an American interest rate matter so much to a Singapore bank? Because Singapore's own interest rates move closely with global rates, especially the American ones. And here is the crucial word for these banks. They are what's called asset sensitive. It's a simple idea with a very powerful effect. It means when rates rise, the interest they earn on loans climbs quickly. But the interest they pay on all those everyday deposits climbs slowly. Income races ahead of cost. So as the Federal Reserve hiked, the bank's loan yields shot up, while their cheap deposits still paid very little. The spread, that net interest margin, widened sharply. DBS's margin climbed from around 1.45% to a peak of roughly 2.15%. OCBC moved a touch higher, near 2.3%, while UOB rose to around 2.1%, roughly in line with DBS. That may sound like a small jump. But on hundreds of billions of dollars of loans, a rise of that size is worth billions in extra income and almost pure profit. Their main engine, net interest income, surged. This is the money they make purely from lending, and it swelled to record levels across all three banks. For DBS alone, that lending income rose to around $15 billion in a single year. The rate wave lifted the whole bottom line with it. And it wasn't only shareholders who felt it. Ordinary savers finally earned real interest again. Fixed deposits and treasury bills paid the most they had in years. The whole system woke up. It was the same bank, the same deposits, the same customers. But in a high-rate world, that machine simply prints far more. The environment did much of the heavy lifting. And there's a timeless lesson quietly forming here. Some businesses are built to thrive when rates rise. Banks are the clearest example. Knowing that helps you read the whole economy. But hold that thought carefully. If rising rates were the tailwind that lifted them, then one day, when rates fall, that same wind turns around. We'll come back to that. It matters. Singapore's own benchmark rate, which tracks these global moves, climbed sharply through 2022 and 2023 as well. Local mortgages got more expensive, the flip side of the bank's good fortune. Because every basis point that helped the banks came from someone paying more: homeowners, businesses, borrowers. A bank's margin is always somebody else's cost. That's worth remembering. It wasn't only margins, either. Their loan books kept growing as Asia's economies expanded. More loans, at fatter spreads, the two effects stacked on top of each other. As trade flowed through Singapore and the region grew richer, these banks sat right in the middle of it, financing the growth and taking a small clip of almost everything. So driver number one, the biggest by far, was really a gift of timing the sharpest rate hiking cycle in a generation, landing on banks built to catch it perfectly. But timing alone doesn't explain everything. Plenty of banks around the world had the same tailwind and still stumbled. What these three did with the windfall is the next part of the story. Because a rising tide only helps the ships that don't have holes in them. So let's look at how well run these banks actually were underneath. That's driver number two. Driver two is discipline. It's one thing to earn a windfall. It's another to hold onto it without blowing up. And on that test, these banks scored remarkably well. The headline numbers were extraordinary. In 2024, DBS earned a record net profit of around $11.4 billion, up about 11% on the year before. $11.4 billion. To put that in perspective, that is a Singapore bank outearning many far larger banks in Europe and America. OCBC was not far behind, with a record of around $7.6 billion, up roughly 8%. Another all-time high for a bank first formed back in 1932. And UOB posted its own record, around $6 billion, up about 6%. 3 banks, 3 records, in the very same year. That is genuinely unusual. Now here's a number that impresses professionals. Return on equity: how much profit a bank makes for every dollar of shareholder money, reached around 18% at DBS. Around 18% return on equity puts DBS among the most profitable major banks in the developed world. Many big global banks would be thrilled with half of that. But high profits can hide danger. When rates rise this fast, the usual fear is that borrowers can't keep up, loans go bad, and losses pile in. So did that happen here? Largely, no. Bad loans stayed remarkably low. The share of loans that turned sour barely moved, even as rates climbed. Borrowers kept paying. The feared credit blow-up simply didn't arrive. And that's the quiet magic of it. Because losses stayed tame, the margin windfall didn't get eaten by write-offs. It fell almost straight through to the bottom line, as pure profit. Then there's the fortress part. Banks are required to hold a cushion of their own capital to absorb losses in bad times. It's the buffer that protects depositors. The risk was that a rate shock would trigger a wave of defaults. What actually happened was much calmer. The loans held up, and the extra income stuck. The key measure of that cushion is called Common Equity Tier 1 capital. Think of it as the bank's strongest, purest layer of safety. And on that measure, all 3 run comfortably in the mid-teens. That's well above the minimum regulators demand. In plain terms, these banks are carrying far more safety cushion than the rules require. They chose to be over-prepared. And that over-preparation created a happy problem. They were sitting on billions of dollars of excess capital, more than they needed to run the business safely. Hold that thought. Because their excess capital becomes the star of driver 3 in just a moment. But first, notice the pattern. Big windfall, low losses, strong buffers. This was earnings quality, not just luck. Their income also grew broader. Fees from wealth management, credit cards, insurance and trading rose. So even as the rate boost eventually faded, other engines were quietly warming up. In fact, in 2025, even as profit dipped slightly, DBS's total income still climbed to a fresh record of around $23 billion, carried by those fee and trading businesses. They are also famously efficient. For every dollar of income, a smaller and smaller slice is eaten by costs. A lean bank turns more of its revenue into profit. DBS in particular spent years reinventing itself as a technology company that happens to hold a banking license. That digital push helped it serve more customers at a lower cost. The result, DBS has repeatedly been named among the best and safest banks in the world by international finance magazines. A small nation bank, sitting at the global top table. Now, I don't want to over-romanticize this. Much of the profit still rode the rate wave. But the point stands, they didn't fumble the windfall. They banked it, safely. The lesson worth keeping: a boom only builds lasting wealth if you don't lose it in the next bust. Discipline in the good years is what carries you through the bad ones. So they had a windfall, and they kept it, which left them with more capital than they knew what to do with. And what they chose to do with it delighted shareholders. That's next. Driver 3 is where the share price really caught fire. Because a bank with more capital than it needs has a wonderful choice to make: give it back to its owners. There are two main ways a company hands money back to shareholders. One is dividends, regular cash payouts. The other is buybacks, the company buying its own shares. These banks did both, generously. First, the dividends. As profits hit records, the banks raised their ordinary dividends year after year. If you own the shares, the cash landing in your account kept growing. DBS lifted its total ordinary dividend for 2024 to around $2.22 per share, an increase of roughly 27% over the year before. A big jump in a single year. Then came the extras. On top of the regular payouts, the banks declared special dividends, one-off bonus payments to share the surplus. OCBC and UOB both handed out special dividends in 2025. OCBC pushed its total payout for 2024 to around $1.01 a share, including a 16-cent special, roughly 60% of its profit returned to shareholders. UOB added a 50-cent special dividend, returning a slice of its surplus capital directly to owners. The message from all three was the same: we have more than we need, so here. The second lever was share buybacks. DBS launched a program to buy back and cancel billions of dollars of its own shares. This part is subtle, so let me explain why it matters. When a company buys back its own shares and cancels them, fewer shares are left. So each share you still hold now owns a slightly bigger piece of the same bank. Your slice grows without you lifting a finger. Spread the same profit over fewer shares, and earnings per share rise. It's a quiet, steady way of making each share more valuable. And these banks leaned into it. DBS went further still. It introduced an extra capital return dividend, paid every quarter, on top of the normal one, a deliberate plan to hand back excess capital over several years. It even issued bonus shares, giving existing holders extra shares for the ones they already held, another way of sharing the spoils of a very good few years. Add it all up, and the dividend yield on these banks climbed to roughly 5 to 6%, meaning for every $100 of shares, you'd receive around $5 to $6 a year in cash. Now think about who finds a safe 5 to 6% cash yield irresistible. Retirees living off their savings. Local income funds. Anyone tired of near-zero bank interest? They came in droves. For a Singaporean retiree, a stable local bank paying 5% plus in cash felt like a gift. Familiar names, regular payouts, in your own currency. Demand for the shares kept building. So owners were rewarded twice over. Fed and rising dividends landing as cash, and buybacks quietly shrinking the share count. Both pushed the value of each remaining share higher. It became a kind of flywheel. Record profits, generous payouts, more buyers, higher prices which drew in yet more buyers chasing that reliable income. Round and round it went. And here's a lesson that outlasts any one cycle. Over long stretches, a huge part of the return from shares comes not from the price, but from dividends collected and reinvested, year after year. Reinvest those payouts, buy a few more shares each time, collect dividends on those too, and over the years the effect snowballs. Boring, patient, and quietly powerful. But let's stay honest. A high yield is only as safe as the profits behind it. If earnings fall, dividends can be cut. A yield is a promise, not a guarantee. Never chase yield blindly. And notice something important for later. By 2025, with the rate boost fading, a growing share of the bank's appeal came from these payouts and buybacks, not from fresh margin growth. That's a subtle but vital change. The engine driving the share price was shifting under the surface, even as the record highs kept coming. Keep that in mind for part 7. Still, driver 3 is real and admirable. Sitting on excess capital, they chose to reward their owners richly rather than hoard it or waste it on bad deals. Shareholders felt it directly. So far, a rate windfall, kept safely, and showered back on owners. But there was a fourth force at work, one that has to do with money flowing into Singapore itself. Let's go there. Driver 4 sits above the banks entirely. It's about Singapore itself becoming one of the most trusted places on earth to keep money. And the banks stood right at the gateway. Over the last several years, the world grew more uncertain. And when the world feels uncertain, money looks for a safe, stable, well-run home. Singapore became one of the favorites. One clear sign was the family office boom. A family office is simply a private setup that manages one wealthy family's fortune. Hundreds upon hundreds of them set up shop here in just a few years. Why Singapore? A AAA credit rating, a stable government, strong rule of law, low corruption, and a trusted currency. For someone guarding serious wealth, that combination is rare and precious. At the same time, slower growth and uncertainty around China and Hong Kong nudged some regional money to look for alternatives. A good deal of it found its way here. And who manages all that arriving money? In large part, these same 3 banks. Their wealth management arms, private banking for the well-off, grew quickly and profitably. This matters because wealth management earns fees, not interest. The bank gets paid a slice for managing and advising, whether rates are high or low. It's a steadier kind of income. Investors love fee income because it doesn't swing with interest rates. So as the rate tailwind was set to fade, this growing fee stream gave the banks a second, sturdier leg to stand on. Assets under management at the bank's wealth units swelled into the hundreds of billions of dollars, and the fees on them rose steadily, a quiet, durable engine humming in the background. UOB, meanwhile, made a bold move to grow beyond Singapore. It bought Citigroup's consumer banking businesses across several Southeast Asian markets. A major bet on the region's rising middle class. The deal covered Malaysia, Thailand, Indonesia, and Vietnam. In one stroke, it roughly doubled UOB's retail customer base in those markets, adding millions of new customers and their deposits. More customers means more deposits, more cards, more loans, more fees for years to come. It was a deliberate move to build a bigger regional franchise, not just ride the rate cycle. All 3 banks increasingly sell themselves as the gateway to Southeast Asia, the trusted bridge for money moving into a region of nearly 700 million people. That's a powerful position. And notice the difference here. The rate windfall was cyclical, it comes and goes. But becoming Asia's wealth hub is more structural, a slower, deeper trend that can last a very long time. There's a lesson in that distinction worth carrying with you. Cyclical tailwinds are exciting but temporary. Structural ones are quieter but far more durable. Learn to tell them apart. To be fair, wealth inflows can slow too. If the world calms down, or another hub competes harder, the family offices could look elsewhere. No advantage is permanent. But for now, it's a real strength. Underneath it all is Singapore's brand, decades of stability, carefully protected. The banks didn't build that alone, but they are among its biggest beneficiaries. The nation's reputation is their moat. And it circles back to that word from the start: trust. In an anxious world, trust is the scarcest asset of all. Singapore sells it, and its banks bank it. So driver 4 is the wealth hub tailwind, global money seeking safety, a family office boom, growing fees, and a bigger regional footprint. Steadier and longer lasting than the rate windfall. 4 forces down. There's one more before we turn to the hard questions, and it's about how the market itself decided to value these banks. That's driver 5. Driver 5 is about perception. Because a share price isn't only about profits, it's about how much investors are willing to pay for each dollar of those profits. And that willingness changed. For banks, investors often look at price to book, the share price compared to the value of the bank's net assets. A price near 1 times book means the market pays roughly what the bank is worth on paper. For years, Singapore's banks traded close to, or even below, 1 times book. The market treated them as safe but dull, steady dividend payers going nowhere exciting. They were, frankly, cheap. Then, as records piled up and payouts grew, the mood flipped. Investors decided these banks deserved more. The price they pay for each dollar of earnings and assets climbed. That shift is called a re-rating. A re-rating is powerful because two things lift the price at once. Profits are rising, and the multiple investors will pay on those profits is rising too. The two multiply together. So the same bank went from being priced like a dull utility to being priced like a quality compounder. Same institution, a very different price tag. Perception did a lot of the work. Now layer on the index effect. Remember, these 3 banks are about half the Straits Times Index. So as they rose, they physically dragged the whole index up to record highs with them. In early 2026, the Straits Times Index crossed the 5,000 mark for the very first time, and went on to fresh all-time highs after that. The banks were the engine underneath that milestone. And here's a modern twist. Huge sums now sit in index funds that simply buy the whole market in proportion. When money flows into an STI ETF, it must buy the banks, because the banks are the index. So rising banks lifted the index, a rising index attracted more index buying, and that buying pushed the banks higher still. Passive money can amplify a trend, in both directions. There was a currency angle too. The Singapore dollar stayed strong. For a foreign investor, a rising share price in a strengthening currency delivers a double gain when they convert back home. So global investors, hunting for a safe market with solid yields and a firm currency, bought Singapore. And the most liquid, familiar names to buy were of course the 3 big banks. In an anxious world, investors will pay a premium for boring safety. Singapore's banks offered exactly that: dull, dependable, well-regulated. For once, boring was in high fashion. The lesson here is subtle but important. Your return depends not just on how a business performs, but on the price you pay going in. Buy something cheap that re-rates, and you win twice. But flip that around, and it's a warning. If you buy after the re-rating, once it's no longer cheap, you've already missed the easy part. And re-ratings can run in reverse, too. Which is exactly the tension we now face. These banks were a bargain a few years ago. After this run, they simply are not cheap anymore. That changes the maths for anyone buying today. So let's gather the 5 forces. 1. The rate windfall. 2. Disciplined record profits. 3. Generous capital returns. 4. The wealth hub inflows. And 5. The re-rating and index effect. 5 forces, stacking on top of one another over the same few years. When several tailwinds blow the same way at once, You get exactly this, a run of records that feels unstoppable. But that word unstoppable is precisely where careful investors get nervous. Because nothing in markets is unstoppable. Every tailwind eventually eases. So now we ask the honest question. Can it last? This next part is the most important in the whole video. If you skip everything else, don't skip this. Let's look, clearly and fairly, at the other side. Everything so far explains why the banks won. This part asks whether the winning can continue and where the real risks lie. And I want to be completely straight with you here. Start with the biggest one. Remember that rate windfall, the single largest driver? Well, it has peaked. And it is now reversing. The American Central Bank began cutting interest rates in late 2024, and cut further through 2025, bringing its rate down to around 3.75%. The tide that lifted the banks is now going out. And as rates fall, the bank's net interest margin, that precious spread, comes back down. Their loans reprice lower. The very asset sensitivity that helped on the way up now works against them on the way down. Margins have already begun to compress. The banks themselves have guided that net interest margin is drifting back toward 2% and below. The easy margin windfall is behind them, not ahead. So if the margin tailwind is fading, what has kept the records coming? Increasingly, it's the buybacks and the wealth fees we talked about, not fresh margin growth. The mix of the story has changed. That's an honest and important reframe. The recent highs lean more on capital returns and fee income than on the roaring engine of 2023. That engine is cooling. Buyers today should know that. Second risk, valuation. As we said, these banks are no longer the bargain they were. They trade well above book value now. You are paying up for quality that everyone can already see. When a stock is priced for good news, it has less room for pleasant surprises and more room for disappointment. The bar is higher. Great companies can still be poor investments if you overpay. Third risk, and it's fundamental. Banks are cyclical. They are geared to the economy. When times are good, they do wonderfully. When the economy turns, they feel it fast and hard. In a recession, more borrowers miss payments, bad loan losses climb, fewer people take new loans, and fees dry up. All the engines slow at the same time. That's the nature of a bank. This isn't hypothetical. In 2025, UOB's profit actually fell sharply, down more than 20% after it set aside large preemptive provisions against possible future bad loans. A reminder that the good times don't run in a straight line. And there's always the risk of a credit event, a big borrower or a whole sector running into trouble, from property to trade. A single serious shock can turn a great year into a painful one, quickly. Now, the strong capital buffers we praised earlier are exactly what helped them survive such shocks. That's the good news. But surviving a storm and thriving in one are very different things. And now the risk I most want you to sit with. It's not about the banks at all. It's about how much of your wealth and your neighbors quietly sits in just these three names. This deserves its own moment. Because it's the risk almost nobody in Singapore talks about, precisely because these banks have been so good for so long. Think about it. You may own the banks directly. You own them again through your STI ETF. You own them a third time through CPF-linked funds. And your parents own them too. The same three names, over and over. For many local investors, once you add up the direct shares, the index funds and the retirement funds, a startling share of their entire net worth rests on the fortunes of three highly similar companies. And these three don't move independently. They're all Singapore banks, exposed to the same economy, the same rates, the same region. When one has a hard year, the others often do too. They rise together, and they can fall together. So owning all three can feel like diversification. It isn't, really. It's three versions of the same bet. True diversification means owning things that don't all sink at the same time. You know the old line, don't put all your eggs in one basket. Half of Singapore is holding one basket, labeled local banks, and giving it a very loving hug. It's completely understandable how we got here. They're familiar, they've paid beautifully, and they kept going up. Success breeds concentration. But a crowd all owning the same thing is a risk, not a strategy. When everybody owns the same three names for the same reasons, the door can get crowded if sentiment ever turns. The very popularity that lifted them could, one day, work in reverse. Now, I'm not predicting a crash. I have no idea what the banks will do next year, and neither does anyone else. The point isn't fear. The point is balance. Know how concentrated you truly are. Balance might mean pairing your local banks with other regions, other industries, some bonds, some cash. Not abandoning what's worked, just not betting everything on it. Room to be wrong, safely. And here's the oldest warning in investing, worn but true. Past performance does not predict future returns. A stock that has hit record after record is not, for that reason alone, a good buy today. In fact, chasing something simply because it keeps hitting new highs is how many people buy in near the top right before the easy gains are gone. Price already high is not the same as price going higher. Let me be fair in both directions. None of this means the banks are bad, or doomed, or that you should sell. They are excellent businesses. It only means the easy, obvious part of the story is now well known and priced in. The honest picture is simply this. Wonderful companies, a spectacular run, powered largely by a rate cycle that has now turned, at prices that are no longer cheap, held very heavily by an entire nation. A thoughtful investor can hold two ideas at once. These are great banks. And great banks, bought at high prices in huge concentration late in a cycle, still carry real risk. Both things are true. So respect the cycle. Booms feel permanent right at the top, and busts feel permanent right at the bottom. The feeling of certainty is highest exactly when caution matters most. So where does all this leave us? Let's pull the whole story together, and draw out the lessons that will still be true long after this particular cycle is forgotten. Let's bring it home. First, what actually drove this once-in-a-cycle run? Then, the timeless lessons you can carry into your own decisions, whatever the market is doing. What drove it was a rare alignment. A once-in-a-generation rate windfall, met by genuine discipline, turned into aggressive capital returns, on top of safe haven wealth inflows, all re-rated by a market that finally noticed. Several powerful forces, blowing the same way, at the same time. That's why it felt unstoppable. And it's also why we should be humble. Much of it was timing that may not repeat. So, the lessons. Lesson 1. Some businesses are built to shine in a rate hike cycle. Asset-sensitive banks are the classic case. Understanding how a business makes money tells you when it will thrive. Lesson 2. Capital returns compound quietly. Rising dividends, reinvested patiently, plus buybacks shrinking the share count over years, that steady drip does remarkable work. Don't underrate the boring stuff. Lesson 3. Boring, well-run compounders win. No fireworks, no hype, just steady profits, careful lending, and consistent payouts, year after year. Dull is deeply underrated in investing. Lesson 4. The price you pay matters as much as the quality you buy. A great bank bought cheap made people rich. The same bank bought dear may disappoint. Quality and price are two different questions. Lesson 5. Respect the cycle. Banks breathe with the economy. Windfalls end, margins mean revert, and the sunniest moment is often when the least caution is being shown. Stay level-headed at the top. And lesson 6, the one I'd underline twice, diversify. Understand what you already own through your shares, your STI ETF, and your CPF before you buy still more of the same three names. So here's a gentle homework, not advice. Sit down and add it up honestly. How much of your total net worth, across every account, actually rests on these three banks? Most people have never counted. For many Singaporeans, that number is far higher than they'd have guessed. And you can't manage a risk you've never measured. Knowing the number is the whole point of this exercise. This is not a signal to sell or to buy. It's a nudge to look clearly at your own picture and ask whether it reflects a plan you chose or just a habit that happened to you. We can admire these banks and stay cautious at the same time. They've been a genuine blessing for Singapore savers. And the way to honor that is to hold them wisely, not blindly. Holding wisely means knowing why you own them, sizing the position so one bad cycle can't sink you, and pairing them with other kinds of assets. Conviction with humility. That's the balance. None of this needs to be complicated. Own good things. Don't overpay wildly. Don't put everything in one place. Reinvest, be patient, and let time do the heavy lifting. Most wealth is built that quietly. Because in the end, the real engine of your wealth isn't picking the one perfect stock. It's steady saving, sensible diversification, and patience measured in decades, not headlines. The banks took nearly a century to become what they are. Your own wealth is built the same way, slowly, steadily, through many cycles, not in a single lucky year. Time is the quiet ingredient. So don't buy a stock just because it's hitting highs, or because everyone you know owns it. Understand the business, respect the price, know your own picture, and decide for yourself. That's real investing. There's a thought I like: plant your trees in different seasons, and some will always be bearing fruit. That, in a single line, is the case for spreading your bets. And to close, honestly, I don't know if the banks will keep rising. Nobody does. What I do know is that understanding what you own beats guessing where it's going. Every single time. One more time, plainly, because it matters. Everything today has been education, not financial advice. Your situation is your own. If you need it, speak to someone qualified who knows your full picture. If you remember just 4 things, let them be these. Understand what you own. Respect the cycle. Diversify. And be patient. Carry those 4, and you navigate any market more calmly. Whether you own a fortune in these banks or not a single share, the principles are the same. Wealth in Singapore is built slowly, understood clearly, and spread wisely. You have time on your side. You don't need to be a genius, or to catch the next big winner. You need to save steadily, keep learning, avoid the big mistakes, and let the years compound. That path is open to almost everyone. The everyday Singaporean who quietly saves, diversifies, and stays patient through the cycles usually ends up in a far better place than the one always chasing the hottest stock. Slow and steady really does win. So the next time you see the headline banks hit another record high, you know it isn't magic. It's rates, discipline, payouts, wealth flows, and perception. A story you can now read for yourself. Thank you for spending this time with me today. If it helped you see your own money a little more clearly, then it was time well spent. That's the whole reason this channel exists. Take care of your health, take care of the people you love, and take care of your money in that order. It all compounds, quietly, over a lifetime. Until the next episode, stay curious, stay patient, and stay honest with yourself about the risks you carry. This has been Lukebook. Take good care. Thanks for watching. If this made building wealth in Singapore a little clearer, give it a like and subscribe to Lukebook so you don't miss the next episode. See you in the next one.